The landlord and owner of a 44-story tall office building in St. Louis, Missouri, which had been worth $205 million, sold it recently for merely $3.6 million, taking nearly a $200 million loss on the building. I'm Tony, and this is Real Estate Investing and Landlord News. All right, so I have an interesting topic for you today, and it's something that I don't cover very often because I am not an expert at it, and that's commercial real estate. Now, the reason I'm bringing it up is because some of the same things that we are dealing with in terms of residential real estate, they are dealing with on a different scale when it comes to commercial real estate. And the story that I'm talking about today is coming out of St. Louis, Missouri. There's actually two stories I'm talking about today. One of them is coming out of Los Angeles, California, and one of them is coming out of St. Louis, right? And so I actually found the story about the St. Louis office building, which sold at a $200 million loss, while I was reading the story about, this apartment complex in Los Angeles that was recently sold at a $30 million loss. So what I'm basically saying is that a lot of the owners and operators of commercial real estate right now are suffering greatly with the increased interest rates, and they're just not able to hit their numbers, and a lot of buildings are sitting empty. Ever since the pandemic, there hasn't been the return to the office like they thought it was going to be, and the office market had already been suffering in certain ways. So you know what? Now things are really looking bad. And you know what? This is a bad thing. This is an absolute bad thing because commercial real estate has enough, money involved in it to make banks collapse. And that could be bad for the entire economy. Now, I don't know what the solution is, but we've got to come up with something, or there's going to be heavy losses suffered by a lot of people. So before I get into the article, go ahead, hit the like, subscribe button, maybe leave a comment down below. Let me know what you think. So anyone on here who owns commercial real estate, specifically office, okay? I'm just curious how you're doing right now, if you have struggled to fill up your office space, if you have 100% occupancy. What have things been like after the pandemic? I'm just curious. I know that a lot of small mom and pop landlords don't dive into that segment of the real estate investing field, but I'm just curious if there is anyone on here who has that experience. Please share with us because I'd love to hear your story. But anyway, let me get into this first article, okay? And I'm going to talk about the Los Angeles topic first because it's really what got me into the story about St. Louis. This article is coming from dailyhodl.com, and it says, JPMorgan Chase takes $29.9 million loss on LA apartment complex in deal with mega landlord, report. Yeah, and like I said, this story led me to the other story, so let me get into it first. JPMorgan Chase has reportedly unloaded a major real estate investment in Los Angeles, taking an 8-figure loss. JPM's investment management division has sold a large apartment complex with retail space in LA's Little Tokyo district in a deal with a mega landlord, The Real Deal reports. Records show that the bank bought the complex on 232 East 2nd Street for about $116 million in February of 2020, but recently sold it for $86.1 million, taking a $29.9 million hit. So you can look at those dates and see, what happened. So they bought the property in February of 2020, right before all the pandemic restrictions locked everything down, forced people to hole up in their homes. They didn't have any jobs, etc. Right? And I'm sure that the people, when they purchased the property, they had the intention of being able to raise the rents up to a certain level in order to make a profit, right? But things might not have worked out for them the way that they planned with all of the stuff going on with the pandemic. So my thought is that, hey, they were speculating a little bit and they lost big because of it. Now, this isn't a person, this is a very large investment group. What do they say? JPMorgan Chase. Okay. We know, obviously, JPMorgan Chase is a huge bank. Okay, and to them, this is just an investment write-off loss. And I don't know if anybody's even going to lose their job over it. Maybe, maybe not. This isn't a company that, like there are some large landlords out there, and that their whole focus is just investing in real estate. This isn't even the case with them. Their investments are much broader than just real estate. Now, does it suck losing this much money? Absolutely. Now, the people who bought this property from them, they made out like a bandit. They got a great deal, but unfortunately, they lost a bunch of money doing it. So really, I'm not talking about them specifically. What I am talking about, though, is it's a sign. It's a sign saying, hey, there is a lot of weakness in commercial real estate right now, okay? Especially like office space. But in this case, this was actually an apartment complex, something that would be seen as a more stable, recession-proof investment. So what went wrong? What went wrong other than we have much, much higher interest rates? So they might have gone back to refinance the place, found the value had dropped, and realized that, oh, you know what? We can't get this place refinanced. Okay, I don't know how this works when the bank itself is trying to refinance the place. I don't know how this works at all when we're talking about large investment firms like this. Are they buying these places cash? Who knows? Okay, like I said, I am not an expert in this field. All I know is that if it was me and I'm seeing this, it would make me very, very scared of purchasing commercial real estate. Okay, that's all I know, and that's why I'm bringing this article to you today. But let me continue. The deal is the latest multi-million-dollar loss in the troubled commercial real estate market amid higher for longer interest rates. Recent office building sales are especially eye-popping as low occupancy rates continue. Last month, one of the tallest buildings in St. Louis, Missouri, sold for only $3.6 million after selling for $205 million in 2006. So, and that's the part where I was like, what the heck? They sold a place for that much of a loss, and I was like, I couldn't believe it. And so I had to do a little bit more research and because selling a building at a $200 million loss is pretty much unheard of. It sounds insane to me. Okay, so the article I found was from CoStar.com, and it says, one of St. Louis's tallest office towers, empty for years, sells for less than 2% of its peak price. Goldman Group buys a 44-story former AT&T office tower for $3.6 million. Now, St. Louis, Missouri obviously is a city that is, has been suffering for a long time with declining population and kind of a stagnant economy in the local area. Okay, so office vacancies were already much higher than they are in other more thriving cities throughout the country, even before pandemic, right? So when I was going through this article, it goes into that whole fact. In the latest sign of how lower demand is hitting parts of the U.S. office market, one of the tallest towers in St. Louis that sold for $205 million in 2006 has changed hands again this week for about $3.6 million. The former One AT&T Center, a 44-story high-rise totaling 1.46 million square feet at 909 Chestnut Street, is now owned by Boston-based Goldman Group. The firm bought the property via CoStar Group's 10X auction exchange from Samara Road Holdings, a commercial real estate investor and developer that paid just $4.5 million for it 2 years ago. On a per square foot basis, the tower's value over 18 years dropped from about $140 to $2.50, according to CoStar data. The block on which the long vacant property sits was declared a blighted area by the St. Louis Planning Commission in 2023. Samara Road had proposed renovating the existing building to develop 306 apartments, 300 hotel rooms, and 37,000 square feet of retail, thus reducing the office square footage by 1.2 million square feet. So, yeah, the place had only sold a couple of years ago for 4.5 million, which is still a $200 million loss, right? But even the people who bought it for 4.5 million ended up selling it for an even, $1 million loss. So this building is, it's, I don't know if they could scrap it. That's what I would say, like, just, demolish the place, sell the scrap metal. They say, the place has been sitting empty for quite a while. I think it said in here that it has been, maybe I haven't gotten to that part yet, but it's been sitting empty for years, okay? And it's in a depressed office market. It's obviously nobody wants it. And now they're just trading it for pennies on the dollar, essentially, for what it was constructed for. And from the look of the tower, I mean, it doesn't look bad. I mean, maybe I'm, it looks like it's an older building for sure. But, like, it would cost hundreds of millions of dollars to convert this building because it is so big over to apartments or condos or hotel rooms or whatever. And so is there a demand in St. Louis for that sort of conversion? I just don't think so, okay? And if there was, somebody would have already done it, because we're talking about now, if it's been abandoned for years and, the whole area is considered blighted, obviously, what do you do? What do you do with a building like this? And, you can't easily repurpose it. You can't, so that's why I say it might be worth it more to sell it for scrap. Man. Let me continue with this article. Maybe it says when it was, it says, a redevelopment of the property could face significant challenges as office space use has changed after the pandemic accelerated the adoption of remote and hybrid work policies. Higher interest rates have also led some companies to scale back on costs for real estate and employees. The nation's central business districts have seen their office vacancy rate climb from a low of 8.9% in the third quarter of 2018 to 16% this past quarter, according to CoStar data. St. Louis's current office vacancy surpasses that at nearly 18.6%. Without the empty 909 Chestnut Tower, St. Louis's vacancy would dip to about 14.3%. So yeah, this building just sitting empty makes up 4% of the office vacancy for the entire city. That is pretty bad, okay? It says AT&T Tower is the second largest vacant office building in the United States and has been empty since 2017, CoStar data shows. So yeah, sitting empty for 7 years, okay? And I don't know how long ago AT&T used to be in this building, if that was their headquarters years ago or whatever, right? But, things have changed, time has passed, and how do we move on beyond this? I don't know. I don't know what the solution to this is, Like, it would suck if it comes down to we're demolishing the skylines in our downtowns because there's no money to repurpose these buildings into anything else. It would also suck if, this was actually a sign that the entire commercial real estate market was about to collapse. I don't know. But anyway, I'll put links to these two articles in the description down below. Let me know what you think of this whole situation.